Hello everyone, welcome back to Idiot's Guide. On today's video, we are going to look at a trading strategy which consistently works with candlestick patterns. I just want to remind all viewers to watch the video without forwarding or missing any content in between because it's going to be a short video walking through step by step the complete process as to how to identify the patterns, what steps to follow when you enter into a trade. So it's highly advisable to watch the video from beginning to the end. Having said that, let's jump into the content. Okay, it is a 4-step process. The first step is to identify the market direction, whether it is an uptrend, downtrend, or range bound. The next step or the second step would be waiting for a pullback in price. The next step or step 3 would be entering the trade using confirmation through candlestick patterns. And the fourth step or the final step would be exiting using preset exit conditions, whether it is stop loss or profit taking order. We are going to walk you through the 4-step process one by one, so please stay tuned. The first thing to start is to have a clean chart with not more than 1 or 2 indicators. If you look at the chart I have here, it's Tesla's chart. I have price on the top and the ATR or average true range at the bottom. That's the only indicator I have on this chart. Now, let's first identify the trend. Let's say you are in this area around June of this year, sometime in June, second week or third week. Now, you need to identify whether it's going to be an uptrend, downtrend, or sideways trend. Let's first draw a support resistance, or let's mark the support resistance area. Support resistance is a range, not a fixed price. If you had a chance to watch if you don't understand support resistance or why they are called as an area, not as a line, please watch our video on support resistance to understand why we have to mark it as an area, not as a single line. Now coming back to this video, this is the resistance area till late May till June, early June. Let's assume you are at June 5th, 2020. You have the resistance area clearly marked. The price has tried to come back to this, retraced. Price has came back to the resistance again, retraced. Then on the third attempt, for the last 4-5 days, it's been trying to break through the resistance. So what would you call this trend as? First of all, higher lows, higher highs, higher lows, higher highs. So the price has started an uptrend from this recent low on March 18, 2020. Please remember, you are right here. We are assuming you are on June 5th, 2020, that is today. So considering we are in an uptrend and price is near the resistance and price is consolidating very close to the resistance, it's one of the early signs that the price is going to break above the resistance. Okay. Now we'll go into the details about how we can get into trade, what we have to do on future steps. Now let's go through the high level on all the steps. Now we identified the trend direction of this market or of this stock. Now the second step would be waiting for a stock to break through the resistance or support and wait for a pullback. You know this is a resistance area, price broke through, and a novice trader will try to chase some stock and try to enter at closing price or sometime during this day. They could have even gotten as high as $1,027.48. But an experienced trader would wait for the price to pull back and then see if the support is respected. See, it was a resistance till this day. Once the price crossed through, it became a support. Now, an experienced trader would not try to jump the gun here or even the next day, would probably wait for the price to pull back and see what happens. Price came down 2 days into the support. In the fourth day, it again bounced back and it respected this area. So an experienced trader would have gotten at this price the next day at the open at $987. See, you could have gotten here at 1025 or you could have gotten here at 987 at the open. Which is better? Obviously this is a better pricing, right? Because that will help you in the reduced stop loss. If you miss this opportunity, you had several good opportunities to get back in. And if you notice it, when support is marked as an area, it never broke through this area. If it had been a line, you would have been stopped out. Okay, the second step is waiting for pullback. That's been completed. Then you could have entered the trade right here. The third step would be using an entry trigger or candlestick pattern to confirm the entry criteria. After the pullback, if you notice, after the first pullback, there is a bullish engulfing pattern here. What are the entry patterns? For bullish, you could use hammer or bullish engulfing. For bearish patterns, you could use a gravestone or bearish engulfing. Now we are looking to go long, means you would be looking for the bullish patterns. Now the fourth and final step would be exit criteria. Exit criteria has to be two different criteria. One is stop loss and the next is taking profit or profit order or profit limit order. The exit orders based on exit criteria would be, for the stop loss, it could be either 1 ATR below the recent swing low for long or 1 ATR above the recent swing high for short. For profit taking orders, exit when you are right, when you are taking profit, it would be just below the next resistance for a long trade or just above the next support for short trade. Ideally, you don't want to try to squeeze every penny out of the trade. Rather, you want to capture a major chunk or major portion of the swing to be profitable in the long term. Okay, now let's explain this concept through an example. Again, we are at Tesla's daily chart here. The resistance area is clearly marked. First, we are going to identify the trend. Let's assume we are right here. Today is June 5th, 2020. Price is right here. What's the direction of the stock? Higher highs, higher lows, higher highs, higher lows. It's a clear uptrend established since March 18th, 2020. So the trend is defined. Now the next thing is identifying or waiting for the price to get to support resistance and do a pullback. The price crossed above the resistance area and it made a pullback. That did happen. The next step is waiting for entry confirmation in terms of candlestick chart patterns. From here, after the pullback on this day, June 15, 2020, the price has formed a bullish engulfing candle. This is a confirmation for an entry on the next day at the open. If you miss this opportunity, when the price hovers around the support area, right here, again it forms a something like a bullish hammer or bullish engulfing, something in between right here. That's a second opportunity to go long. Now the pullback at the pullback area, or the location where you can enter the trade, can be marked by support resistance or using a moving average or through a trend line. Now let's take a look at an example for moving average. Okay, let me remove the support resistance example from the same chart. Again, it's the same Tesla daily chart. I have marked a 21 period moving average. There is no rule as to whether you should use 10 period, 21 period, 50 period, whichever moving average fits the particular stock, or whichever moving average is respected by the particular market, you can use that for that market or the stock. In this example, Tesla's chart is clearly respecting 21 period moving average. You could see that when it falls below 21 period, it tried to touch it, the moving average has been respected, and the price retraced back drastically. Then it tried to cross it, it acted as a resistance. Then once it crossed, it's acting as a support clearly for a long period. So 21 period moving average is an excellent moving average for Tesla's stock, but could vary from stock to stock. Anyway, now instead of support resistance, let's say you are using moving average for identifying the area to enter the trade. You could have gone long here after the price crossed the 21 period moving average, or you could have gone short here after the price broke through the 21 period moving average. If you missed both the opportunity, instead of chasing the price all the way here while it's going up, how the novice trader do, you should wait for the price to pull back to the moving average line. You could have entered here, you could have entered here, or you could have entered here, or you could have entered here, or here. What happens when you enter when the price gets close to the moving average? Again, it makes your stop loss much smaller, which in turn results in a much higher profit. In the long run, that will make you a successful trader. Okay, when it's time to identify the entry trigger, we should look at a couple of powerful candlestick patterns to decide where it's the right time to enter. Personally, I would prefer, if it is a bullish or long trade, a bullish hammer or a bullish engulfing candle. If it is bearish or short trade, I would look for a hanging man or a bearish engulfing pattern. Let me show you an example using a chart of Beyond Meat. This is a daily chart of Beyond Meat. If you look at it here, right after this downturn, here is a bullish engulfing pattern. This basically covers a previous day's body completely. Today's body is covering the previous day's body, and it's in green. It's a bullish engulfing pattern. Do you see what happens after 2 days? The price keeps going up from the next day onwards. Now, let's look at an example of bearish pattern here. This pattern is called hanging man, basically a long wick with a small body at the bottom. That's called as a hanging man. That is nothing but an opposite view of a hammer. I will show you what is hammer next. So when this pattern happens, the market is supposed to go down. But the key thing to keep in mind here is, whenever you look for an entry for a bullish or bearish pattern, you cannot just look at only that candlestick to decide. You have to look at the action, the previous few candle bars action, to decide whether it's a valid signal or not. Market had a downturn already. then you're seeing a hanging man. Then the candlestick pattern is not valid. But the thing that is valid here is, look at an example here. Look at an example here. This is right. Okay. What we have in front of us a Beyond Meat weekly chart to illustrate what candlestick patterns to look for when you have to enter a trade or for the entry trigger. We would be focusing on probably two most valid patterns: an engulfing pattern or a hanging man or a hammer pattern. A engulfing pattern can be bullish or bearish, and the hammer is a bullish hammer, and the bearish equivalent pattern of that is called hanging man. I'll show you an example of each one of them. In this chart, if you look at this candle here on Jan 10th 2020, the body of this candle has covered previous few candles body completely. This is a very strong bullish engulfing pattern. See what happens from next week onwards. Price keeps going up. Now when the price gets to here, do you see a small body with a long wick on the top? This is called hanging man. It creates an impression like a man is hanging on a rope. When this pattern happens after a uptrend, of a certain period, a prolonged period, it could be considered as a valid signal for a downturn. Can you see what happened afterwards? The price started going down for the next few weeks. Then after a few weeks, again you could see the patterns forming for bullish and reversal for bearish. A pattern like this is a hanging man with a small body with a long wick on the top. An opposite of this would be called hammer. A hammer would be, let me see if I can show you a hammer in this chart. Right here, the recent weekly chart. It's not a perfect hammer. It's got a small wick on the top. Hammer should have no wick, almost none to a very small wick, with a small body and a long wick down. That would be considered a perfect hammer pattern. Even I wouldn't consider it a hammer. This comes close to a hammer, but again, it failed here. Always, no pattern is a guarantee. So always you should have a stop loss to protect yourself. Let me see if I can show you a pattern of hammer and hanging man, a few more examples. Okay, it's the same Beyond Meat daily chart. After the downtrend, can you see a hammer forming here with a small body on the top with a long wick? What happens next? The price keeps going up. A pattern is valid. You cannot take a pattern as valid signal without taking the context into picture. The context is what happened in the previous few candles and the previous session, or previous few sessions I should say. The price has been coming down for quite some time, then this hammer pattern formed, then it's one of the valid signals. If it had been close to support resistance as we covered in the previous step, then it's a very valid signal. Now again, if you look at here is a bullish engulfing pattern. The body of this candle covers a previous candle and the price keeps going up. This pattern is valid after a downturn. It would have been a very solid confirmation if it is near a support or resistance. Now if you follow along the same chart, here is a hanging man, a long wick with a small body after an uptrend. So the chances of the pattern being valid is very high. And what happens next? Here is a bearish hanging man, the price goes down. Don't look at the color of the candlestick when you look for a signal. Always look for the pattern. The color comes next, whether it's green or red. Basically, you need to take three things into consideration. One, what is the price range? Where did the price close in terms of range? That will give you an indication on who has it in control? Is it the buyer or sellers? I hope that clarifies in terms of identifying the patterns. To summarize, we'd look for either bullish engulfing pattern or a bearish engulfing pattern. Or you look for a bullish hammer or a bearish hanging man. Now let's look at another example of entering using a trend line. Let me move this. Let me add a trend line here. Okay, so if we look at this trend line, if you use trend line for entering any trade, your entry position or entry area would be when the price hits the trend line close to the trend line. Like you could have gone long here or here and put the stop loss below this. I'll explain the stop loss on the next step. You could have gone long here, here, or in this 3 candles, or right here. Instead of chasing the price anywhere in this exponential move, because then when the price comes down, your stop loss could be much bigger and the risk to reward ratio would be very small. In the long run, you'd be losing money if you chase any stock or commodity or any market. So you have to patiently wait for the price to come back to your pullback area, which is nothing but touching the trend line. Okay, now we are looking at 4th step, which is exit criteria or exit conditions. You should always enter 2 types of orders or conditional order or one cancels other whenever you get into any trade immediately after you take the position, so that emotion doesn't come into picture. One part of the order would be stop loss, the other part of the order would be profit taking order. Let's first look at the stop loss order. For the stop loss order, assuming you got into the trade using trend line as an example, as you can notice here, I have average true range or ATR plotted at the bottom of the screen. I normally use ATR for identifying my stop loss. So if you look at it here, let's say you entered the trade here as an example, which is April 2nd, 2020. What is the price of ATR on that day? 59.45, so about $60. So what I would do, I would enter my stop loss $60 below the low of the day. That would put us at 446 minus 60, so you are looking at around 376. So let me draw a line. $376. So if you gone long on this day, your stop loss is right here. So you are giving enough room for the price to breathe while it makes its way up. At the same time, you have defined your stop loss. So you can do position sizing based on the stop loss. You can calculate your position sizing, Okay. Now, the second leg of the order or exit criteria order is profit taking order. How do you define where to exit? A consistent, successful strategy would be, as I said, predefine your exit. When you are in this area, when you went long here, you know there is a resistance in this area, right? This high is a resistance area. So if you have to mark the resistance area, you'd be marking it like this. The reason for that is support or resistance are not single line. They are an area where price respects that area. If you don't understand what I mean by area is support and resistance, please watch our other video about support and resistance to get more information. Now coming back to the profit taking leg of the exit criteria order, you know the price retraced from this level. That would be between 923 to 973. So you could put your profit taking order around somewhere in the middle. So something like 950. So your stop loss would be $60 below the low of the price which you entered on the day. That would be around here at somewhere around 446 minus 60. So we saw it as 386, I believe. And then your profit taking order would be around 950 because that's a price that has been respected in the last two tries. So the price comes to here. Have you noticed? It's struggling to break above this. From this day, which is June 1st to June 29th, almost 1 month price was trading in that area. You could easily have put your exit profit taking order in this range and get out and wait for confirmation for the price to close firmly above this price, like here or here. Then you can enter into the next trade or move on to next stock. If you're worried that the stock may continue to run like this case, you could always take 50% of your position at the nearest resistance at this level. Let the remaining 50% of your position run. So that way you locked in your profit, you don't lose money, you are guaranteed for the profit, plus you are not missing out on the additional gain if the stock keeps running. That concludes the presentation on how consistently we can be profitable using candlestick patterns and a simple pullback strategy when we trade on a day-to-day basis. Okay, let me summarize the 4 steps we need to follow to be successful in trading on a day-to-day basis. Step 1, identify the market direction, whether it is uptrend, downtrend, or sideways or range bound. Step 2, wait for the price to get near the support and resistance area and pull back. Step 3, wait for candlestick patterns for entry trigger to occur. It could be bullish pattern for a long trade and bearish pattern for the short trade. Step 4, create stop loss and profit taking conditional order or one cancels other order and enter that order immediately after taking the position. This concludes this presentation. I hope this video of any value to whoever is watching this video. If you like this content, please like this video and subscribe to our channel. It takes a lot of time and effort to create a free useful content like this. If you could like and subscribe to our channel, that will really encourage us to create more and more free content that could be of value to each one of us. Thanks and have a great day.